Hey guys, Matt McKeever here, and so this is an unusual video. It's unlike any other video I've done on my YouTube channel in my YouTube career. What we're going to do today is, this is a real life case study we're going to dive into. This is a used storage center, so it's essentially one of those centers, where people store their shit that they're never going to look at again. One of those roll up door things. Anyways, the seller was claiming if they sold it to us at a 10 cap rate, that this property was worth $1.4 million. After we dug into the numbers, in under an hour of due diligence, we determined that this property is worth less than $500,000. That's a $900,000 error. If we're being nice and we're giving the seller the benefit of the doubt. Otherwise, that's a $900,000 fraud that this seller tried to pull on us. So, if you guys enjoyed this video, smash that like button, hit the subscribe button if you're new to my channel, and share this video on social media, guys. Sharing is caring. It's the only way I get new subscribers. It's the only way my channel grows. So please share this on Reddit, on Facebook, on Twitter, on Instagram. Share it on your Snapchat. I don't really care. Just share this somewhere if you got value from it. If you want to see me make more videos like this, share it on social media. And if you want me to dive into maybe something you're looking at, send me the documents and we'll dive into it. The only thing is, make sure you don't sign an NDA, because that's a non-disclosure agreement. If you sign that, you're not allowed to share the information. Thankfully, this seller, being so sloppy as he is, he didn't make me sign an NDA, so we're going to dive into the information right now. Let's do this. So the point of today's video is, we're going to be just kind of walking through a seller's package. So what this is there's a self-storage place, or like a U-storage place, or a public storage type thing. The whole thing is, there's a whole bunch of little cubicles that people store their shit in, and they rent out that space. So we're looking at today a property that has 107 self-storage units or parking spaces that are for rent. It's in London, Ontario, and so thankfully in this case the seller didn't make me sign an NDA, so I can actually disclose any of this information to you guys because they didn't make me sign anything. So normally what's going to happen is, if you're looking at, say, buying a business or a real estate property and you want to get a lot of the financial information, particularly if it's a larger business or a larger property, you may have to sign what's called an NDA. And so that just simply stands for a non-disclosure agreement. So essentially what you're saying is, if they give you access to their financial statements, if they give you access to all the information that shows you whether they're making money or not, you're not allowed to disclose it. This time I didn't have to sign one, so let's walk through it. I have hidden their information because I don't want to be a dick. But what you're often going to find in these situations are that these sellers will really inflate their numbers. And in this case, this is actually a real estate agent that's selling it. So he's the owner and seller. And you'll see as we dive into the numbers, but this is a great example of how some sellers will try and take advantage of unsophisticated investors and simply try and make a huge promise on the returns or the projected returns, instead of actually disclosing what's actually happening. So what we have here, first of all, just so you guys know, I kind of a rickety setup here, but so we got camera here, we got our information there, another information there, and your camera 1, camera 2. So this is the main document they gave me. It's breaking out essentially all the information related to the 2014, 2015, and 2016 years, as well as showing 2017 and a projection for 2018. So, first of all, when you're getting information from a seller, always realize that they have a vested interest in portraying their property or their business in the best light. So they're usually going to be aggressive with their income numbers, and they're going to be forgetful. We'll call it forgetful when it comes to the expenses, or they're going to be naive when it comes to the expenses. So usually what the seller's going to do is they're going to try and inflate the income, and they're going to try and decrease the expenses, which will make it look like the property or the business is earning a lot more money. And since it's earning a lot more money, the business or the property is worth more money, because most sophisticated investors are going to value a property, an investment property or a business, on the valuation of the income. So it's really important that we actually understand if this income number here is actually legit, because otherwise we're buying a bill of goods. So just a little bit of background on myself. None of this is auditing or accounting advice that we're about to dive into. I'm just going to be sharing my experiences and my personal approach when I'm looking at this sort of information. I may use words like audit or review, but that's not actually what this is. First things first, when you get this financial package from the seller, take a look and find out whether it's been prepared by an accountant. If it has been prepared by an accountant, a CPA, have they done what's called a notice to read? Have they done essentially just a compilation or a notice to reader? Have they done a review, or have they done an audit? And so it's important to understand these different terms, simply because a compilation or a notice to reader means they've done no due diligence. They're providing no assurance that the information provided there is correct. If it's a review, they're essentially providing negative assurance. So they're saying, so Real Cole's notes version, they're kind of saying we didn't notice anything that looked too crazy. And an audit is where they're actually diving into the numbers and they're getting support and confirming the validity of the information to a certain degree of probability, kind of. This is not a technical video. I'm not going to dive really deep into all the accounting terms. And if you're really looking at a business or a property and you're concerned about the financial statements, get a review or an audit done by a professional CPA. That'd be my biggest recommendation. But I'm going to walk you through just kind of how we approach things, and at least I'm going to walk you through how I approach things. So first things first is you just want to get organized. So get all your information together. In this case, what the seller provided me was they provided me an appraisal report. There's only really one page of that appraisal report that attains to any financial information. So I have that page here. As well, they provided me a 2-page summary that simply is a revenue and direct expense report is what they're calling it. Essentially what it is it's a 4-year... Essentially what it is it's a 4-year summary on the income and expenses and net income, as well as showing a 2018 projected income statement. So this is gonna be a long video, guys. So pull up his chair, get comfortable. We're gonna get into some numbers. So, like I said, the first thing we want to do is just get organized. So what you want to do is label your different documents. So in this case, this is going to be my primary document, so I'm going to just call it A. And just to remember that, I'm going to put an A up here in this corner. So this is A. And so just to say extra organized, I'm actually going to number the pages of this as well. So this is A1, and this is A2. This page here, this page is directly from the appraisal, so I'm going to call it B1. So now I have my 2 documents, A and B. And the reason I'm going to label these, you'll see in a minute, but we're going to want to cross-reference the information here. And one thing I forgot was my trusty calculator. Boom. Need a calculator for this stuff. And so the very first thing we're going to do here is simply, we're going to confirm the validity of all these different numbers. So first things first is we're just going to use the information we already have to figure out what we have versus what we don't have. So on page A2 here, we can see here's the current rent roll. And here's the rent roll with the building in 2018. So a little bit of background on this property. As I said, it's a self-storage unit. But what happened was in 2017, they built a new building. And so if we read through this summary here, the subject property is improved with a 6-building self-storage complex with a total of 97 indoor unheated units as well as 10 outside vehicle storage spaces. The building contains a total area of approximately 16,700 square feet and were constructed in 1980 as well as one recently pre-constructed steel building. There are also 2 washrooms and 1 small office. A breakdown of the size and quantity of the self-storage units is as follows. Blue highlighted units are in the recently constructed rear building. So this is the new building here. Just so we're all on the same page. That's the new building. I'm just writing new just to remind myself while we go through this exercise. But so we can see there's, on B1, we have 107 units that's stated on this property. So then jumping over here, we can see 107 here. So the very first thing we're going to do is we're simply going to confirm that these number of units agree, that the units on this page agree to the units on this page. What we're going to do is we're going to assume that nothing the seller tells us is the truth, and so we're going to double check everything for ourselves. So in this case, we're just going to simply add up all the different units, and boom, we have 107 now. So, since I have agreed that this 107 adds up, I'm simply going to foot it here. And so foot just means that I've actually added it up. So in accounting, what a lot of accountants will do is simply have an arrow here. And that means that this actually adds. And so since we can see 12, 8, 36, 15, 8, 12, 6, 10, I know that that adds as well. So boom, we have that adding. Then what we're going to simply do is we're going to take a look at, then what we're going to do simply is confirm that all these units tie out. So 12, 19, 10, 20, 9, 16, 10, 14, 10, 10, 8, 9, 5, 10, and outdoor. And we got 12, 8, 36, 15, 8, 12, 6, 10. So that agrees. So this document in this case, this is from the appraiser. So this piece of paper I can trust more than what the seller provided me because the seller has a vested interest where the appraiser has to stand by a certain code of conduct. So in this case, I can rely on the appraiser's information more than I can the seller's. So I'm going to use this as one of my source documents. So all I'm going to say here is that all this information agrees to this, and that since this is my source document, I'm going to put A2 on it. So that means this 12 here, this 12 I've confirmed over here. So when I'm looking at this, my main document, I'll be able to remember that, oh, am I positive that there's 12 units? Oh, well, I'll double check B1, and when I go B1, then I'm going to look for something that references A2. So in this case, A2. So essentially, we're just going to do that for everything. So A2, A2. And then just to remind myself that these were actually new units, I'm just going to put a 1 beside it. And then down here, I'm just going to make a note to myself. And on this note, I'm simply going to say, I hope that shows up right. If this all shoots backwards, I'm going to be pissed. So essentially, I just have my 1s here. I'm just going to say new building 2017. So the only reason I'm marking this is just kind of a note to myself that these are the new units. That may come in handy later. I don't know for sure, but the key is I kind of want this A document to contain all the relevant information I'm going to need to make a decision, and everything else is just going to be supplementary info that I've already vouched to here. So essentially now, we're essentially done with this B1. There's really nothing else that I can take over from this document to vouch to here. So I'm just going to set this aside, move that over there. And now what I'm going to do is simply confirm that all these numbers cross multiply. So in this case, what I'm going to do is they're saying there's 12 units, price of 150 equals 1800. So 12 times 150 equals 1800. Since that multiplies, I'm just going to put a little arrow here telling myself that, yeah, I cross multiplied that. That was cool. This 21,600, I'm going to do this 21,600. I'm going to do the same thing. So that should simply be 1,800 times by 12, 21,600. And now I've already gone ahead and double checked all this math. So all this is fine. Some people will use check marks. Some will use these arrows. It doesn't really matter, guys. I'm just going to use checks here, just to speed it up. So boom, all these are good. Sometimes you're not going to be able to make a decision right away. You might need more information. And so you're going to have to set this document aside. And so if you've set it aside and the seller doesn't get back to you for, let's say, a couple weeks or even a month with more information, you'll forget what you've already done. And you don't want to keep picking it up and putting it down and redoing the same work, because what ends up happening is you get fatigued. And when you get fatigued, you get sloppy. So we don't want you getting sloppy. So essentially, we've confirmed that this is all good here. So what I can see here is 137,400 is what the total max occupancy would be. So this essentially, if everything was fully rented out at these prices. So we're essentially done with this page for a little bit. So we're going to come back to this one. In this case, what we've got here is we've got what their actual rents were. So first thing you're going to notice is these actual rents aren't the total rent. So that means they either have bad debt or vacancy that's occurring, which is resulting in them not fully renting out the properties. Now what we're going to do simply is we know that 110,400 is our max rent possible, but we only collected 94,500. So what we're going to do is 94,500 divided by 110,400, and that gives us approximately 85.59%. So I'm just going to put over here occupancy to remind myself of what this percentage is. Now I've done it for the other ones, so I'm just going to fill them in here. But feel free to do it yourself if you want. I'm not going to dive too far back into 2014. That's kind of stale data as far as I'm concerned. I'm just going to look at the 3 most recent years. You can do whatever you want when you're doing this. It's always better to do more information. But just for brevity's sake, that's all I'm going to do on this guy. And so what we're going to do now is we're going to add up the expenses and confirm these subtotals, because again, we can't trust the seller because they have a vested interest in presenting this data in the most in the best light possible. So because of that, we want to make sure that we're being accurate So because of that, we just want to make sure the accuracy and the validity of this information. And of course my battery's going to die. God damn it. So as we can see, this added up. So we're going to just put our little foot again saying that this added up. Now that we have our subtotals and we've confirmed them, now we're just simply going to take our total rent, subtract the total expenses to get our net income, and we're just going to confirm that again. So simply we're going to take our 94,500, subtract our 47,103.95, and Alright, so we've already noticed one strange thing, and that in this case is that this doesn't add up. Our net income doesn't equal rent subtract our total expenses. So, it's not a big difference, but it's still very strange. So right now, our difference stands as $164 difference. So, why would this be different? Well, obviously they weren't using Excel or a formula to calculate this number. So what we'll often find is sellers will play around with their expense or their rent number, potentially to make it look nicer. And what they forget to do is, if it's not automatically linked as a calculation here, it's not going to auto update. So what they do is they'll play around with these numbers or this number, and then we can tell that these numbers don't add up. The moment you find a number that doesn't subtotal or add up the way you'd expect, that's a huge sign that something's wrong here. That's a giant red flag right there. So that the moment you discover something like this, you need to be extra cautious with the numbers you're using. So what we're going to do now is we're going to dive deeper into all these other numbers and make sure that they work out as well. And so simply here, to remind myself that this is what it should be, I'm just going to put an SB beside it, should be, and this should be 33,277.69. So again, we have another discrepancy here. That's a really bad sign. That makes me believe that no one really proofread this and that they were probably playing around with the numbers at some point, and that's why we're getting different totals. So let's look at 2017 and see what sort of crazy kookiness they have in store for us on this one. So take my 94,500, subtract 47,103.95. I get 47,396.05. So they undersold themselves by 14,118.36. So that seems crazy that they accidentally didn't show enough income here. But again, this is probably someone that was playing around with the numbers, and that's why these totals don't add up. There's no reason why a seller would be underestimating their net income in this presentation to us, because that means we're going to want to pay less for this property. So why would this all happen? So what you're going to find is a lot of people in real life really focus on taxes in their day-to-day operations of their property. So what they'll do is they'll maybe inflate their expenses for tax purposes, and then when they go to sell the property, they try and deflate those expenses when they're presenting it to the seller. So my guess in this situation would be that odds are that they probably underreported their rent or overreported their expenses for taxes. Then when they took their taxes and tried to build out this report for us, they forgot to update this income line. So I would bet that this is probably what they actually reported for taxes, but this is what they think actual expenses were closer to and actual rents were closer to. So this is something important too, just to notice. Yeah, because as you can see right now, obviously this doesn't give me a lot of faith in what's going on here. But we're going to set that aside for now. We're going to come back to this later. But for now, let's focus on these 2018 projections. So as a note to ourselves, remember, we had this new building in 2017, which added these 3 new sets of units. So just as a reminder, that brought 22 new units. As a percentage of what they used to have, I'm going to take this 85 divided by I'm going to take the 22 new units and divide by 85, and that's going to give me approximately 26%. So I'm going to say approximately 25% more units in 2018, because these were built right at the end, new building, end of 2017, and so we have 22 new units, or approximately 25% more units in 2018. So the reason that this number is important is I'm going to use it as a basis when I'm looking at their expenses, because now, since they have more units, I'm going to expect them to have higher expenses, because it makes sense. If we have 25% more units to take care of, I expect to see a proportionate increase in things like wages, utilities, and property management, and or repairs and maintenance. So let's take a look at it. When we're looking here, when we're looking at the year-over-year change here, nothing too drastic. This looks pretty reasonable to me. So I'm not going to mark it up. When I look at telephone, this looks pretty reasonable to me. The only thing that's interesting is all these even numbers. So one note, guys, is if you see too many even numbers, usually that's the sign that someone's playing around with their numbers, or they're making estimates instead of actually portraying the actual expenses incurred. So if we see a lot of even numbers and a lot of 0 zeros, that's a sign that probably these are estimates or best guesses rather than the actual expenses incurred. So that's maybe a red flag we're going to want to note. Otherwise, when we look year over year, these all seem relatively similar, so I don't see any major red flags. This all looks pretty reasonable, the way that these numbers have increased or decreased over the years. So nothing too major going on there. Again, when we look at our total expenses, things seem reasonable. Now, what is interesting is, in 2017, our occupancy increased drastically. So we went up to 85.6% occupancy versus 72 and 70%. So now that I've noticed that this looks a little bit different, I'm going to think to myself, maybe I should go back and look at this 77. So that's 77,434 divided by our 110,400 gives me a 70%. And so what may have happened is they may have been increasing the rents over the years. And so maybe our potential rent in 2014, 2015, and 2016, that may not be an accurate reflection. And so that's probably going to be something we're going to ask them for additional information in the future if we decide to proceed with this deal. But for now, we're just going to keep moving on with this one. So I'm just going to take the last 3 years as an average. So in this case, I'm just going to put a 1 beside it again. And I'm going to make a note to myself up here. And that simply is that 3-year average occupancy equals 76.2%. So what I'm going to want to do here is, now for my 2018 projections, when I'm looking here, I'm going to want to take our total potential income, our 137,400, and times that by my average 3-year occupancy. So first thing I can tell right off the bat is this 178,500. This number looks really weird. So I'm just going to put a question mark to it because I really want to highlight that to myself in the future to come back and double check this number, because that just seems so crazy to me. What I'm going to do is just try and keep my page relatively clean. So what my actual expectations of this is going to be, I'm going to expect this to simply be, I'm going to make the assumption that my actual rent should be 137,400 at a 76.2% occupancy. And in that case, that's going to give me approximately $104,699 for gross rents. I'm almost $75,000 difference here. That's ridiculous. That's insane. This is a big red flag. So that we're already off to a really bad start here for their 2018 projections. So I'm really not expecting this number to come together. But one thing I should do is I should just confirm all these expenses. So again, I'm simply going to go 8,400. So that adds. So that's good. Then I'm going to take my 178,500, subtract by 42,632. 135,868, so that adds, so that's good. So let's take a look. let's compare these expenses, the estimated 2018 expenses now, to what my actual expenses in 2017, 2016, and 2015 were. So, wages. They're showing essentially, in effect, no change year over year. So, I'm just going to put a little column here, year over year, and I'm going to say that approximately this was no change. So this little squiggly line just means approximately. So all I'm saying here is approximately no change year over year. Then I'm going to look at this 700. Again, we're saying approximately no change. Utilities 4,500. Again, approximately no change. And so the reason that this is kind of strange for me is we can remember that we have 25% more units in 2018. And again, we're expecting more units rented out. So that seems very strange. Insurance, it looks like there's a small increase in insurance. So I'm going to say that the change here was approximately $400. So the triangle just means change or difference. So change, approximately $400. My common elements. Common elements. I didn't have that before. So that's interesting. So I'm just going to want to put a little question mark here. Why all of a sudden do we have common elements now? So that's something I'm probably going to want to follow up with the seller with and be like, why all of a sudden in 2018 do we have common elements, but we didn't have it in 2017, 2016, or 2015? So this is a change of $500, or this is a change of $5,000. So I'm just going to mark that for myself. Repairs and maintenance. Now they have repairs and maintenance going down by $1,000. And I should probably just put an arrow up there to remind myself of that. And now what we have is our change is approximately $1,000 down. That seems really unreasonable, seeing how we're renting out more units, 25% more. We have 25% more units. We have one whole new building, but our repairs and maintenance is actually going down. Now, they may have simply put some of the repairs and maintenance under common elements for their 2018 projection. So that's kind of hard to say. We may have to give them the benefit of the doubt in this one, but we still just want to mark it as a note. So, then property taxes. This is where things look really strange. For the last 4 years, we can see that we're around $21,000 to $23,000 a month in property tax. However, we dropped by nearly $10,000 without any explanation. So that's very strange. That's a big question mark here. So what I'm simply going to do is 23,053.95 subtract 13,832. So that's a decrease, or that's a change of $9,221.95. Now this is really strange. There may be a good reason for this, but at first blush, I see no reason. They didn't explain it to me, so that's highly suspect. So some reasons that this might be a reasonable decrease is maybe there was a special assessment and that special assessment is over. Maybe there was some sort of maybe there was some sort of debenture on the property from the city. So maybe they hadn't paid. So maybe they'd done a water upgrade or some sort of upgrade to the services to this property, and that's been fully paid off now as of 2017. That could be another good reason for why this has dropped so much. But right now, this looks highly suspect, and I don't trust it. So what I'm going to want to do actually is I'm going to want to increase these. So in general, I'm going to do a 25% increase year over year simply because I have 25% more. I'm going to assume a 25% year over year increase simply because I have more units now. So instead, what I'm going to want to do is I'm going to take these numbers here and increase it by 25%. And that's what my actual expenses are going to, and that's what my actual expected expenses are going to be. So in this case, instead, I'm going to take the average of these 3 years. So I'm simply going to go put a 2 here, a 2 here, and a 2 here. And I'm going to make a note to myself down here at the bottom. 2. Average 3-year expense equals, divided by 3, means I'm expecting $46,536.63 if nothing changed. But if I assume a 25% increase, then I would actually expect my total expenses to be $58,170.78. So in this case, I'm going to say my expected expenses, I'm just going to put a 3 here and 3 here. And so the reason I'm putting the 3 in front is that's from here. So that's all that really means, is that's the source information. So in this case, expected expense equals $58,170.78. So my actual expected net income now is my $104,699 in gross rent, subtract $58,170.78, or $46,528.22 in net income. So, what the hell happened here? We're going from $135,868 in income to $46,000. This is a difference of $89,339. Let that sink in. The net income we're expecting versus the net income they're expecting, we're only getting approximately 34%. This is 34% of this number. That's ridiculous. This is beyond. This is the stuff that infuriates me. This is just insane. This is so wrong that someone's trying to take advantage of buyers out there. Like, it's really hard to give them the benefit of the doubt in this situation, simply because these numbers look so bad. They look so incriminating when we look over it. And we haven't even been able to confirm any of these yet. So imagine if we keep diving deeper what we're going to find. So, but before I even go any further into these numbers, let's just simply talk about what else would we do if we were still interested in this deal. So if we were still interested in this deal, we're going to want to see their income tax filings for a couple of years ideally. So we're going to request that so that we can see if we can vouch the income tax filing numbers to these numbers. Because again, that income tax filing, it's more like a trusted third party source, simply because it's something that they told the government is true. And a lot of people are more scared about lying to the government than they are about lying to a potential buyer. So that's one thing we're going to check. Otherwise, what we can do is we can ask to see some of these expenses. So for utilities, we can request their utility bills for the last year. We can add those up and see if it adds up to $4,200. Same with insurance. We could either ask for a statement from their insurance company or simply get their insurance policy and see whether it cost them $2,800 a year. Repairs and maintenance, we could ask to see those receipts. And property tax, we could confirm with the city or the municipality whether it's $23,000 and whether in 2018 it's expected to go down by almost $10,000. So what we would do is we'd get more source documents similar to what we got from this appraisal, and we'd call it, let's say we get our property tax bill from the city. We're going to call that C1 for the property taxes, and we'll vouch that there, and we'll put a C1 here if we're able to confirm the expenses. Otherwise, let's take a look at this again. Remember, we were saying if this was true, the $135,868, if that was a 10 cap rate, we'd be willing to pay, it means we'd be willing to pay $1.35 million for this property. Whereas for this number, at a 10% cap rate, we'd be willing to pay $465,000. So if we were solely buying this property based on a 10 cap rate, based on the changes we've made to the net income statement here, that's almost a $900,000 difference in purchase price. $900,000 in purchase price. Let that sink in. It's completely unacceptable how sloppy this financial statement appears to be from the seller, especially since they're a realtor. They should know better. This isn't fraud. This is so close to it. This is so misleading. This is terrible. This is completely inappropriate. The out and out lies that some sellers will tell buyers in order to try and get maximum price. And that's why you need to do so much due diligence yourself. That's why you need to dive into this. So at first blush, based on the income statement they provided us and the future projections, we'd be willing to pay almost $1.4 million. Whereas once we've ran the numbers and actually dug a bit deeper into them, it looks like we'd only be willing to pay under $500,000. That's $900,000 in difference. $900,000. And literally this was with what? You guys saw it. This was under an hour of due diligence I was doing here, and I determined that I'd be willing to pay $900,000 less because I spent an hour digging into the numbers. Imagine once we start digging further into these numbers, what other secrets are we going to find? What other little white lies and black lies are we going to find? Anyways, hope you guys enjoyed this video. This is a very unusual video. I don't think there's a lot of it out there on the YouTube yet, following this sort of format where we dive into actual real numbers. This is a real life case study, guys. A real life case study where I'm showing you $900,000 in difference between what the seller's saying and what we're saying the property's worth. Simply because we did an hour's worth of due diligence. Ridiculous. Absolutely ridiculous what they're trying to get away with here. So, hopefully you guys enjoyed this video. I enjoyed walking through it with you guys, and this is just a high-level due diligence. You need to be diving even deeper than what I showed you in this video. You need to be getting those utility expenses, those property taxes, the insurance costs, all of that before you go firm on this sort of deal. So, if you enjoyed this video, smash the like button, hit the subscribe button if you're new to my channel. Check out the other videos YouTube wants you to check out. And please, 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 guys, share this on social media. Sharing is caring. It's the only way I get new subscribers. So please share this video with your friends, your family, your dog. I don't care. Just get me more subscribers. Until next time, remember, making money is a team sport. There's more than enough money out there for us to all make it. But if you're not saving it, I mean, what's the point? Thanks, guys. Bye!